Okay, let's start over. Um, Good morning, everyone. It's Friday, the 24th of April, 2014, 8:06 a.m. It would help if I have the mic turned on, and now I do. Apologize for that. I'm not 100% this morning. Um, Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. Looking at the news, little progress likely in today's Eurogroup meeting, but there's some optimism. Germany's IFO survey hits a 10-month high. Europe is um, getting the benefits of the lower euro. U.S. dollar has been a mover overnight so far. Chinese HSBC flash PMI fell to a 12-month low at 49.2 versus 49.6. Um, That is the fourth consecutive month of contraction. Remember, anything below 50.0 is contracting. Eurogroup chief Dieselblom reiterates need for a comprehensive reform list from Greece is required to conclude review before aid is released. So we still continue to see the squeeze on Greece for more money before money's released. So that's the theme for today, basically. We'll talk about the technical theme in a minute. Finally, March durable goods, U.S. March durable goods orders have a blast through the expected rate of 0.6%. They come in at 4%, and durable goods ex transports come in at negative 0.2, expected positive 0.2, so negative 0.5% lower. Looking ahead at the session, we don't really have much. We have the ECRI weekly index coming out at 9:30, and Baker Hughes rig count for the energy industry at noon. We had a reaction to the Baker Hughes rig count a couple months ago when it was way off, but I don't expect it to be a mover. But those are important to watch if you're trading crude. And as far as speakers and other events, the only thing that's affecting us today is the Euro area finance ministers and central banks meeting on Greece. So we expect commentary throughout the day. Um, we may see press releases, comments, and movements in those markets. Just now, Varoufakis, who's the finance minister of Greece, is ready to make a big compromises for a deal, he says. You're likely to see reactions on the euro, Bund, and so on and so forth. Those products throughout the day today. So I'm keeping an eye on that. Let's switch and look at our technical picture, which is what you're here for. We made new highs yesterday, new all-time highs on the S&P. If you recall, and if you've been listening a while, I've been talking about the triangle formation and the anticipated breakout on the upside. All things were pointing to the fact that we have been in balance for a while. Identifying the market condition or the state of the market is supremely important to our trading. Obviously, if you're trading some sort of an algo or a programmed system, that may not take it into account. You're playing a pure probability game, but my approach is to understand context and where things have come from, and what they're doing now, the quality of the job that they're doing, and where they're likely to go based on statistics. That pretty much comprises everything. My approach to trading from the time I started equities as a heavy So's Bandit type scalper to a heavy multi-thousand round term per day future scalper to now having a more structured and more firm view of the trades. In other words, positions, when I take them with a firm hand rather than a weak hand. And it took a while to develop that, and I'm sharing that with you, and of course with anybody that's been listening for a while here publicly and openly. So we break out of our triangle and we are trading up here at 2110.50, holding above a triangle. We did not have the sell-off that we've seen recently. As soon as we make new highs, you can see here 2110, we make a high, push up, and boom, we sell off, and then we have a correction. 2107 tried on the 2110 and sold off, but all of these highs that we've made, 2101 quarter when we were here, sold off. So we're holding tight up here. So that brings us to the chart that I have not put up for a while, which is our fundamentals chart, to look at the quality of the underlying equities. This is the SBX cash chart. This is not the futures chart. And we continue on our bull trend from way back. We're continue holding this trend, and you notice that we're trading right in the middle of the channel, right up here. So it's not a it really isn't a blowout type of trade. Overall, I'm looking for the New York Stock Exchange, as well as the New York Stock Exchange 52-week highs, as well as the lows, to measure how supported the move is. And yesterday's move got some okay support. The first standard deviation, or the second standard deviation line, is 396. Anything above that, we're likely to see a recoil. That's a statistical study based on how often we have held up there and what happened. Down here, the put-call ratio. This profile is essentially showing us the 68.2% as well as the 95.45%. That's the first standard deviation and the second standard deviation of all the data going back to the beginning of this trend. And I'm looking at the put-call ratios, end-of-day put-call ratios. The lighter color here represents the first standard deviation, what we would consider to be normal, statistically normal. And this last run up, the push through the high here, we would expect to see put call to be somewhere in the middle to lower. It's right in the middle, so there's nothing special to take out of this. We have not hit the second standard deviation for a while. Nothing crazy has happened for a while. The bottom pane here shows XLV, which is the healthcare sector, which has been on a tear. It's the strongest of the key 5 sectors in the S&P 500. XLY being the consumer discretionary. XLK, as you already probably track, is the technology sector. XLF, the financial. XLI is are the industrials. And we're looking at how these things are moving and what's dominating on a relative percent basis. So these 5 sectors represent about 76% or so of the S&P 500 weighting. So that's why I look at it. So overall, looking at this fundies chart, this looks like a pretty plain vanilla type high. The expectation is for the market to slow down, ease up, and then continue higher. So my targets, as I've been talking about over the last few weeks, my targets above 119, 120, 120 to 123, 2120 to 2123 are the key projected targets above, and I expect that we would hit those within the next week or so. We'll see how that works out. Looking at yesterday, just to run down what has happened. Yesterday, I was looking for a drop into the 1991-92 area. We only got to 94.75. The opening type was an open auction. We were in range. We were opening right in the middle of the prior day's profile, and we basically traded out of it. We tested one side, pulled back to the open, broke through, and pushed all the way up to the high of the last 3 days. 2103.50 significant. So we have it here, 2103.50, 2103.75. We pushed by a tick, and then yesterday this was a third time at it, making it a week high. So as I tweeted out during the day, look out, this top is likely to blow. Before it did, we had a very, very, very Gaussian profile, or very normally distributed profile, showing a lot of compression for the day. So again, given the failed auction from the prior day, And the fact that we were up at it, given the volume that was traded right in the middle here, I did caution that the push up is likely to be explosive. We pushed for an 8.5 point rotation and continued higher for another 6 points or so to the high of 2114.50. And then this pullback on the close is a fairly standard new high book balancing end of day type of move here that we got into the close. So, and then following that, of course, Google's announcements and so on. So that's what happened yesterday. What do we have? What are we looking at for today? Yesterday was a wide range day. So if we look at our range stats here, let's zoom this down. If we look at our range stats here, yesterday was right on the edge of, actually the last 2 days were right on the edge of what we would consider normal. This profile on the side is dynamic. It looks at all of the ranges going as far back as October 9th, 2013, and it's computing the what is normal, what is the first standard deviation, which is at 20.25. Yesterday's range was at 1975, off by half a point. So nothing outstanding there. I expect today to be fairly muted, not seeing a reason for this to push out. Caveat, the Eurogroup meeting, who knows what'll happen there and what'll be announced. But for now, again, we're likely to have an opening where the market's likely to be fairly two-sided on the open. We're opening in the upper distribution. We're likely to fall into the middle distribution. The point of control did not move to the high end of the range. I expect today to test lower. The support is expected around 2103.50, but I expect it to be a rotational day. It's Friday. As always, do not stake too much of your account on a Friday. It's tough. We always want to watch risk, but Friday is an especially touchy day. Taking the damage from Friday into the weekend causes a tremendous amount of emotional debit on your confidence. We don't want that. It's very, very hard. It's easier to recover from a loss, a financial loss, than an emotional loss. I've had that experience many, many times, and my prop traders have too, and it's very hard to get out of. So we want to protect against that by keeping our risk always in check. We have to trust that we will take our stop when the time happens, okay? And move on to the next trade. If you hang on to a trade that's a loss and you just keep working it and working it and working it, you're missing out on the trade that could have worked in your direction. This is all about statistics, folks. This is what we're trading. When your emotions come into the market, chances are you're not going to get what you want out of this job you're pursuing. Okay, so I'll leave you with that. I'm not going to go over crude, Euro stocks, and so on and so forth. I'm already over my time. Good luck today, and I'll catch you soon. Stage 5 traders, we have our webinar at noon today. Our AAQ, we'll go over the pop quiz and take your questions. Good luck. Take care.